hearing from Mr. Fabian Knopf, Senior Associate of Business Development for Dezan Shira and Associates in Shenzhen. He will be presenting on Hong Kong and Singapore holding companies. Before we begin, allow me to introduce you to our firm. Dezan Shira and Associates is a specialist foreign direct investment practice providing business advisory, accounting, tax, and payroll services to companies investing in China, India, Hong Kong, Singapore, Vietnam, and the rest of emerging Asia. Currently, we have 17 offices in 5 jurisdictions and liaison offices in Italy and the United States. Fabian will now begin.
Today I want to talk about Hong Kong and Singapore holding companies for investments in Asia. As an increasing number of companies enter and expand into Asian markets, holding companies in these 2 international business centers are becoming increasingly more relevant as a structure that can have tax advantages, easier access to neighboring markets, and as a hub for multiple investments in the region. Over 60% of investments to China are finding their way from Hong Kong. While investments from native Hong Kong investors are certainly significant, many other investors use a Hong Kong company to move into the Chinese market. The strong geographically close markets of Taiwan, Singapore, and Japan, as well as South Korea, are all represented with the world's large Western economies, such as the US, the UK, France, the Netherlands, and Germany. Clearly, Hong Kong is favored as a location for investment to China, while Singapore is only in 3rd place. Mauritius is the clear favorite for investments into India. This is due to the fact that a lot of Indian businesses use the island state as a round-trip location for their investments to India because of an exemption to capital gains tax. There has been a change in the general anti-avoidance rules, however, that eliminates this benefit. Investments from Singapore are the runner-up in this chart, while Hong Kong is not within the top 10 at all. Let me introduce you to holding companies and their characteristics in the first part of my presentation, and then move on to describing the Hong Kong and Singapore holding companies in more detail. Hong Kong and Singapore have been, for many years, are in fact today and are expected to be major international trading hubs and financial centers in Asia. They consistently rank among the top of the World Bank's Ease of Doing Business Index across most categories. Notice, however, the relatively grave divergence from the top and between the cities when it comes to the enforceability of contracts. Inserting a holding company in between the parent company and the local company can have financial benefits in terms of cash pooling for further investment in the region without repatriating them to the parent company, as well as tax benefits on profits, dividends, and capital gains. In both jurisdictions, investors enjoy a stable banking and legal system. The corporate income tax is very similar at 16.5% and 17% respectively in Hong Kong and Singapore. There is no value-added tax in Hong Kong, while companies in Singapore pay a goods and services tax of 7%. Dividends are generally not taxed. This is not true for Singapore if they're originating from a tax haven, though. This chart shows the difference a Hong Kong holding company can make as opposed to investing directly. The withholding tax for dividends between Hong Kong and China is under treaty application only 5% as opposed to 10% with most other jurisdictions. Hong Kong doesn't have a tax on dividends source outside of its jurisdiction, nor does it have a withholding tax on dividends when they are transmitted to the initial investor. Similarly for Singapore. Both Hong Kong and Singapore can enjoy 5% withholding tax on dividends under the respective double tax agreements with China. Also, Singapore does not tax dividends unless originating from a tax haven and places no withholding tax on it when transmitting it to its investors. Investors in India and Vietnam using Singapore enjoy no withholding tax rate for transmitting dividends to Singapore. Hong Kong relies on a territorial tax system, which only places its taxes on income that is sourced from within Hong Kong. Singapore expands on its tax base and includes foreign sourced income that is realized in Singapore unless specific exemptions apply. It does, however, in contrast to Hong Kong, offer a variety of tax incentives to companies. Hong Kong doesn't distinguish between resident and non-resident for the purpose of profit tax. It offers companies with entirely foreign-sourced income an exemption from its profit tax, generally referred to as the offshore status. Companies in Singapore are deemed as tax residents if control and management is exercised there. Tax residency entitles them to certain benefits not available to non-tax residents. Let's have a look then at holding companies in Hong Kong. Because of the closer economic partnership agreement, CEPA, Hong Kong has another advantage for investments into China. The agreement most recently in April 2012 further liberalized trade and services. It also covers several goods that trigger a zero tariff preference and services that outside of the agreement face higher restrictions. The kind of company commonly used in Hong Kong is a private limited company, which requires at least one director, a company secretary. In the case of a company limited by shares, one founding member must hold one share, and an address in Hong Kong, which doesn't have to be a physical office. There are no requirements on the minimum amount of paid up or nominal share capital. Such a private limited company restricts rights of its shareholders to transfer shares, limits the number of shareholders to 50, and prohibits an invitation to the public to subscribe to any shares or debentures of the company. Before registering the company in Hong Kong, the future name can be checked against the current database of companies' names online. The registration of the company is with the company registrar and Internal Revenue Department at the same time. The memorandum and the articles of association are important documents for the company registration, which also include the incorporation form and the notice to Business Registration Office. Documents can be submitted by hard copy or, for standard cases, online. Registration certificates for hard copy submissions are issued within 4 working days, while certificates after online submissions are available within 24 hours. The annual compliance process is comprised out of the annual general meeting and the filing of the annual return. The first annual general meeting has to take place within 18 months of the incorporation date of the company. Thereafter, there should be a meeting in every calendar year, and meetings should never be more than 15 months apart. At the meeting, profit and loss accounts as well as balance sheet and directors' reports are presented. Dividends are declared, if there are any. New directors are elected, replacing the ones that are retiring, and auditors are appointed. The annual return has to be signed by a company director or its secretary and filed within 42 days of the most recent anniversary of the company's registration date in the case of a private limited company. The double taxation agreement between Hong Kong and China has been in effect since 2006. The permanent establishment within it is defined as a fixed place of business within a state for 180 days within a year or 300 days within 2 consecutive years. The DTA covers taxes on immovable property, profits, dividends, royalties, capital gains, and interest. In contrast, let's have a look at the case for Singapore. At the time of recording, Singapore has 69 comprehensive DTAs with other jurisdictions worldwide, while Hong Kong only has 18. This provides the city-state with an advantage over Hong Kong in attracting multinational companies that can benefit from treaties for its global business locations. The requirements for Singapore are slightly more stringent than they are for Hong Kong, although there will be changes to these in Hong Kong in 2014. The common company to incorporate in Singapore is the private limited liability company, and a registered service provider will be needed to be engaged if neither of the shareholder, directors, or secretary carry a National Registration Identity Card, or NRIC, an employment pass, or dependent pass. This is to satisfy the requirement that at least one director and company secretary are Singaporean residents. The paid-up capital requirement is as low as $1 Singapore, and a physical office address must be provided. The Accounting and Corporate Regulatory Authority, or ACRA, is responsible for the registration of the company in Singapore. After the company name approval, which among others include the specifications of the principal business activities according to Singapore Industry Classification Code, SICC. For regular companies not requiring additional approvals, the incorporation is finished within 15 minutes after the incorporation fee is paid. Other approvals can take between 14 days and 2 months. The requirements regarding the annual general meeting are the same with them in Hong Kong, with the exception that companies can decide to dispense with the meetings altogether. Accounts prepared for a general meeting should be prepared not more than 6 months before the date of the meeting. The company has to file its annual return 1 month after the annual general meeting with ACRA. The permanent home and the center of vital interest, as well as a fixed place of business, determine the concept of the permanent establishment in the DTA between China and Singapore. As most DTAs are 75% alike in their wording, the taxes covered under the DTA are the same as they are in the case for Hong Kong. During our presentation, we have received a number of questions, and I'd like to revisit the most relevant ones here for the purpose of sharing them with our online audience. One question asked whether Hong Kong is more suitable for investment into China and Singapore more suitable for investments in other parts of Asia. There are a number of points that speak for such a perspective. First, Hong Kong is geographically, culturally, and politically closer to China than Singapore is. Also, the closer economic partnership agreement between Hong Kong and the Chinese mainland is an advantage to investors to China using a Hong Kong investment vehicle. Similarly, Singapore is embedded within the Association of Southeast Asian Nations, ASEAN, which provides advantages in terms of lower import duties on a large range of products. Its comparatively large number of DTAs make it interesting for multinational companies who are not just interested in China, but also India and other Asian markets. It is important to keep in mind that different investors may have different strategies and existing global structures that influence their decision making. Where to locate an investment vehicle for investments into Asia also depends on the mid and long-term plan of the company. Another question picked up on the change in the Hong Kong Companies Ordinance and whether it will have an effect on Hong Kong as a platform for holding companies. The new Companies Ordinance was passed in July 2012 and will come into effect in 2014. It focuses on four main objectives: enhancing corporate governance, ensuring better regulation, facilitating business, and modernizing the law. Examples for each objective respectively are: every company is required to have at least one natural person to act as a director and should clarify that individuals' duty of care, skills, and diligence. The enforcement regime shall be strengthened in relation to the liabilities of company officers to the company's contravention of the new Companies Ordinance, including lowering the threshold for prosecuting an offense by introducing a new formulation of responsible person. Simplified financial reporting shall be facilitated for small and medium-sized enterprises. New provisions for withholding directors' residential addresses and full identity card or passport numbers of individuals from public inspection shall be introduced in order to foster the protection of personal data. We don't believe that it will have a significant negative impact on Hong Kong as a location for investment vehicles into China. There's a global trend for more transparency of the ownership of capital, and many jurisdictions are passing legislation to facilitate this.
Thank you for listening to this episode of the Asia Briefing webinar series. If you have any additional questions about today's webinar, please feel free to connect with Fabian Knopf at fabian.knopf@dezshira.com. For more information about business and regulatory news, please visit our website at www.asiabriefingmedia.com. Follow us on Twitter at Asia Briefing or at Dezan Shira, and like us on Facebook. Finally, to help our listeners better understand Singapore and Hong Kong holding companies, Dezan Shira and Associates publishes a host of helpful business guides, periodic magazines, and other business-oriented resources. This webinar was produced by Asia Briefing Media for Dezan Shira and Associates, www.dezshira.com. Thank you for listening to today's webinar.